Good morning, sir. We are fine.
Hi, so we are 28 to 29 of us. All right. Okay. All right. So the last time we had a discussion on binomial models, which was a discrete time system. Now we can take a step ahead and try to relate that with a few things which go on in the continuous time space. So we have discussed a few of these points, I think, in the last week. Mean, standard deviation, relevance of ODEs, PDEs, etc. I think we have discussed quite a few. Okay. So, so I think covariance correlation up to here we have definitely discussed. Did we discuss the relevance of ordinary and partial differential equations and ideas around root finding, etc.? So did we cover these points as well? Discrete and continuous we did yesterday, so that I know. But these three sub points, have we discussed them? Do you recollect?
No, sir.
No, sir.
Okay, okay. So we can quickly go through that as well. Uh, so, so I'm sure everyone must have worked with ordinary and partial differential equations sometime in the past. So maybe not in the current course, but I'm sure as a part of your undergrad, this might have been covered. And of course, those who come from a science background, you'll definitely have this as a part of your curriculum. So when I say ordinary differential equation, let's say I write something like y equal to f of x. When I write something like, so here I say y is a function of a variable x. So y is my dependent variable, x is an independent variable here. So when I say it's a ODE, ordinary differential equation, I write something like dy by dx. That is, I say y is a differentiable function of x. So this is very, very similar to calculating a slope of line, isn't it? Because if we draw a straight line and we mark, so I can also write this or I write this in a discrete form. This is almost equal to y2 minus y1 upon x2 minus x1. So this is just like a slope of a straight line. So you can visualize it that way. This is what we call as a first order ordinary differential equation. So it could be represented by something like this possibly, whereby I have x2, x1, and I have, x2, y2, and I have x1, y1 here. And then I simply calculate the slope of the line. Now, when I write something like a d2y by dx square, what would happen? And what is the advantage that d2y by dx square, or maybe what is that additional feature which this thing will have, which a first order derivative doesn't?
So it checks the convexity, uh,
Correct,
rate of change of slope.
correct. So, in a very crude manner, can I say that this also understands curvature? Because I am of a higher order, isn't it? Now, earlier we had a straight line, dy by dx. So this did not understand anything of change in curvatures, etc. But whenever I go to a higher order differential, that is a feature which I get. So that is something which we call as the curvature of a yield curve, or maybe curvature of any line, I would say. So generally, as you go on increasing the order of your differential equations, more and more flexibility gets added to the overall system. But generally in finance, up to a second order differential should be good enough. You won't require higher order differentials other than this. So this is what we call as a simple ordinary differential equation. So there are rules around how do you calculate ordinary differential, etc. So we'll not get into that, but in the usual ones which we have studied earlier. Similarly, we have a related concept called as a partial differential equation. Uh, so can someone tell me when and why do I require a partial differential? So firstly, uh, maybe you can think of any scenario whereby ordinary differential cannot be used. So that will help you answer where a partial derivative gets used. So would anyone like to try that? So how do I decide whether I go in for a ODE or whether I go in for a PDE?
Sir, I'm not sure, but can I answer?
Yes, please.
So maybe when there are more than one independent variable involved.
Correct. Very good. So if I have something like y is a function of ABC. So here now y is dependent on multiple items. So we have A, B, and C, and y will be a function of each of them. So if I write something like a dy by dA, this will be this would mean that y is dependent only on A and it has nothing to do with B and C. But this isn't the case, isn't it? Because y is a dependent function of all three. So writing an ordinary differential here will be incorrect. I cannot write it this way. I have to write something like a dabba y by dabba A. So the idea behind this is we are telling the model that we want you to understand what is the variation in y for a given change in A. And we also appreciate the fact that y is a function of b and c as well. So that's why we are taking a partial differential equation. So how do we calculate this? So to calculate this, we measure the change in y for a given change in A by holding b and c constant. Similarly, if I have to calculate, let's say, a dabba y by dabba c, then the way to calculate this is I'm trying to understand the variation in y for a given change in c by holding a and b constant. So that's how I can calculate a partial differential equation. And in most of the times in math finance or quant finance in general, you'll require partial derivatives to be used often. So many a times you'll have a certain variable which could be a function of, let's say, an asset and time. So whenever this is the case, you always require something like a partial differential equation. So for any plain vanilla product, this is like a usual form which we use to study the evolution or maybe understanding the value of that particular asset. And generally, even if you're looking at let's say an exotic product whereby you have a basket linked payoff. So something like V is a function of X, Y, Z, and time. So again, this complicates things because you have multiple underlines here. So that way, again, it's another form of a partial differential. But you may have to go in for a first or a second order partial differential equation depending on what the scenario is. But this is in brief the idea behind a ODE and a PDE. Also, we have done a quick recap of these concepts. So can you think of something in fixed income whereby ODEs and PDEs get used? So where have we studied that from a fixed income perspective?
In duration, I think.
Correct. And any other concept?
Yield curve.
Correct. So yield curve is the underlying. So we are trying to understand the sensitivity to the yield curve. So duration is one. Any other concept whereby we may have applied an ODE? So duration, yes, I can write something like a dP by dy, where P is the change in the price of the bond for a given change in yield. So a related concept. So someone had actually answered that at the start of the class when we spoke of a higher order equation. So one of you had actually given the answer at that time. So can you recollect?
Convexity, sir.
Absolutely. Very good. So this is where I can apply ODEs to fixed income as well. So that way, these are concepts which you can apply across different asset classes. So we can apply it to fixed income, options, etc. Then a brief idea on numerical root finding. So have you worked on any kind of root finding techniques in the past, or do you maybe have it as a part of your broader course also? So anything which might have been covered maybe as a part of your undergrad also, something which you can recollect. Okay. So have you heard concepts like, let's say, a Newton-Raphson technique?
No, sir.
No, sir.
Okay, so I'll generally give you an idea. So there is Newton-Raphson, there is bisection, etc. So to give you an idea of where numerical root finding gets used, now we know even the most simplest form of quadratic which we solve, that is also nothing but a numerical technique or a numerical root finding technique. So whenever we have something like y equal to ax square plus bx plus c, we have a ready solution for this, isn't it? That is, we say the roots of this equation are x equal to plus or minus I can't erase this, is it? So minus b plus or minus root of b square minus 4ac upon 2a. So this is also a very simple example of root finding. So now this is like a ready formula which we already know, which you can apply for a quadratic equation. But for a certain higher order equation, so let me switch to the whiteboard. I can't really write the entire thing here. So let me just stop sharing for a moment and I'll reshare my paintbrush. The paintbrush showing. Now, does everyone recollect the equation for pricing a bond using the YTM concept? We'll talk a bit about, we'll do a quick recap of fixed income at a later point in time, but do you recollect the bond pricing equation?
Yes,
So
sir.
using cash flow.
Yes, absolutely. So it's nothing
Praful,
but,
you go ahead. You
yeah,
answered.
please go ahead. Yeah. So, so yes, I mean, as you guys rightly said, it's simply discounting of cash flows. So I'll just write a generic equation here. Let's say I have a 3-year bond and let's say it pays out annual coupons. And FV is the face value, Y is the YTM. Let's say this is a traded bond. So I have my bond price on the left-hand side. I know at a certain price it's being quoted. The bond coupons are also known. Let's imagine it's a plain vanilla fixed coupon bond. Face value is known as well. Now the only unknown here is the yields or the value of Y. Now, can I say this is also one form of root finding? Because if I open up the brackets in the denominator, I need to find the best fit value of Y, which will help me balance this equation. That is, the value on the right hand side should equate to the value on the left hand side, which is the bond price. And can I say this is an example of root finding? So would that be correct?
Right, sir.
Correct. So this is one of the simpler examples whereby you have to use root finding for your analysis. Now, if you have to do this in Excel, then how would you want to do it?
Sir, we'll denote the cash flows, then discounting factor multiplied by, then get the discounting factor, and then at the end we discount the terminal value.
Yeah, but if you have to maybe calculate this value of Y, which feature in Excel would you guys prefer to use?
Sorry, sir, I don't know much about Excel, sir.
Okay. So there's a technique called as goal seek. So goal seek or even using the solver add-in. So this is something which you can use in order to arrive at a solution using Excel. Now, again, this will be like a trial and error estimate because even Excel will not be able to tell you in one shot what's the value of Y. So generally there will be a certain number of iterations which Excel will try before it converges onto a solution. And this is always the case because whenever you're doing root finding, you can't really have a one-shot solution. It's more of an iterative process before you find an optimal value for a root. Now, this was in Excel. Now, I know you guys know Python. So in Python, can you remember or can you recollect any library which will support such kind of root finding operations? So I understand you guys must have covered this as a part of your business analytics class. Okay, so have you guys covered or studied scientific Python? So have you guys used SciPy before?
No, sir.
Okay. So basically in Python, what all things have you guys covered? So that, I mean, because we'll be using some bit of Python along the way. I'll be using both VBA and Python. But Python generally, what all things are covered?
So NumPy, Pandas, Matplot, and some bit of scikit-learn.
Okay. Okay. So they haven't really covered SciPy, is it?
So they have used like, but they have not like discussed a
Okay.
lot with about cyber.
Okay. Okay. All right. I mean,
Sir,
yes. Yes.
more than
Yeah, I think some problem with the echo. Yeah, please go ahead. Okay, machine learning models. Okay, okay, I understand. Okay, okay. So if I understand correctly, your course has been more catering towards machine learning side of things. Is that correct? Okay, so the
yes,
Yes,
sir.
sir.
concepts
Yes.
are not really. Okay, okay, okay. But other, I mean, anyways, you guys know the ideas behind these libraries. So that way, you can actually apply these libraries to various concepts as well. Because yes, concepts are important, but having hands-on skills is also equally important. So since you guys have been introduced to the concepts, my request will be that try out a few things yourself. It's not very difficult. So SciPy supports all of these root finding techniques, which I mentioned earlier. So Newton-Raphson, bisection, etc. Everything is there as a part of your SciPy library. So something which you can definitely check out, and it makes things very easy. So compared to a goal seek or solver added in Excel, SciPy is a much cleaner way of doing things. And there is a way in which you can write such equations in Python as well. So there is a property of a lambda function. So you say lambda of x, and you write the equation which has to be solved on the right, and you can solve it through a simple for loop through iterations. But do check this out. This is pretty interesting, and SciPy has a multitude of features which you may end up using. So one is root finding. Other can be interpolation techniques as well. So we'll talk a bit about interpolation when we talk of interest rates in one of our subsequent sessions. But SciPy supports interpolation also. So maybe something which you may want to check out at a later point in time. So I would say that although too much of hands-on might not have been covered in your other class, take time out and do it yourself, because that is something which will add value. And ML learning concepts, yes, they are very fascinating and all, but finally being able to implement those things in practice is equally important, because finally your client is going to ask you for a deliverable. So they'll say that you know the concepts, that's really nice, but we want you to help us implement those concepts in our systems. So that's where your hands-on skills will come useful. So my request will be that try out a few things. And a few good resources to do that is either try to implement any concepts which you learn along the way, or those of you who are targeting to enter into data sciences or who have already bagged a job as a data scientist, you may try out Kaggle. So do you guys use Kaggle.com?
Yes, sir.
Correct, yeah. So this is a decent resource for getting databases. So that way you can apply various techniques which you study. So that will give you more time to practice, I would say. But do practice hands-on. That is equally important along with the theoretical bits. Okay,
Sir,
so
I
this
have a
was,
question, sir.
yes, please.
Sir, which are the most important library that you were used while working as the model validation practitioner in the bank?
So NumPy, Pandas,
Okay.
SciPy, sklearn to some extent, Matplotlib to some extent, and other the smaller ones like Math Library, etc. But I think these
Yes,
four or
sir.
five. But I would say NumPy, unless it's a advanced analytics thing, NumPy and Pandas and SciPy, that is good enough to answer almost every question.
Okay, sir. So we have to like focus more on these three library at this time, right?
Yes, and that is something which I mean, you don't have to spend too much time right now. And that is
Yes,
something which
sir.
you can study when you start working on a project.
Yes, sir.
So I think a few months back we had built a interstate calculator for a bank. So that was entirely in Python. So I had done the entire coding myself only. I think that code I had used plain NumPy and pandas, absolutely nothing else. So simply using vectorization, slicing, and arrays, etc. So I think in about 1,000 odd lines of code, there was no other thing which I used other than math, NumPy, and pandas. So, so that way, it's a those are a couple of powerful libraries which can serve a lot of applications.
Okay, sir. And sir, for finance, same all these libraries.
Yeah. Similar ones, yes.
Okay.
Of course, I mean, new libraries keep on getting added all the time. So that you may want to use, so at times you may have to go in for probably a stats model also. So in case you want to use time series analysis, there is a TSA library as well, if I recollect. But yes, I mean, more or less, whenever you run into any issues, there's always a user forum whom you can check out, I mean, what would be the appropriate library to use. So that way, user support is pretty prompt for Python. For R, I'm not very sure because I don't know R programming. I don't know it yet because I never had to use it. But of course, if a client project comes in, then I'll have to use R. Let's see.
So, but we have more hands-on experience with R rather than on Python, sir. Like in college, we have actually taught about more on R.
Correct. Because I think, because since yours is an economics institute, I think for economics slash statistics slash econometrics, R happens to be a more powerful and a popular tool to be used. So I think that could be the reason why you guys use R more.
Yes, sir. And it is simple to execute also, sir.
I see. Okay. So good. I mean, that gives me motivation to learn R as well. So that way I can offer that to my future clients. So let's see. I'll also, or maybe I'll take guidance from you guys to learn R. All right. Okay, that was root finding, discrete and continuous time systems we discussed the last time. Also, have you guys been introduced to the concept of random numbers?
Yes, sir.
Okay. So any idea why we require random numbers? So what are we trying to capture through usage of random numbers in our application? So maybe even a non-finance application, if you can think of, whereby random numbers could be handy. Pick any application which you like. And so basically you know the concept. So maybe you have to just extend it an idea. So anything which you can recollect.
So to take non-partial decision, we can say like.
Okay. Any other view? Okay. So the idea behind having random numbers in our analysis, let's say we are talking from an asset modeling perspective, or let's say I want to do asset price modeling. So I'll write one equation. It may look slightly weird right now, but we'll talk about it along the way. So I'll write something like ds equal to rs dt plus sigma s dw. So we are going to be spending a lot of time understanding this equation and using this for asset price modeling as well. So that will be probably in our class on Saturday and in the next week as well. But the thing is, this is a simple equity asset price diffusion. So this is also what we call as a diffusion equation. So through this, we try to understand how would an evolution for a certain stock happen. So you can imagine ds is the increment in the stock price, which I'm talking about, and we have ds equal to rsdt plus sigma sdw. So on the right hand side, I can split this up into two parts. One is what we call as the deterministic portion, and the other is what we call as the random portion, random or stochastic portion. So what the terms of this equation are, R is the risk-free rate, S is the stock price, T is the time step. So in the first term, everything is known because R, you can simply look up Bloomberg or Reuters and you know what is the risk-free rate. Stock price is the current spot rate, which you already know. DT is the time step which we decide on. So again, that is something which we know as well. Then we have sigma, that is volatility. Now again, we can assume sigma to be constant because many times when we see the equation for the first time, we feel that sigma is the component which introduces randomness, which isn't really the case because we can hold sigma as constant and then use the same sigma in our analysis. So again, that's not a source of uncertainty. Stock price is known, so this is the same S which we used earlier. Now DW, this is the portion which introduces randomness into the overall behavior of the asset. So do we have anyone from physics, from a physics background as a part of our class?
I
Okay.
don't think so. There is
Okay,
anyone.
okay, okay. Because those from a physics background might have been introduced to the concept of geometric Brownian motion. So we'll talk a bit about GBM along the way. So GBM is the idea whereby physicists try to understand or had tried to understand the behavior of particles in space, maybe dust particles in space as well. So that is where the concept of GBM gets used. So that is something which we borrow from physics. And it is this DW part which introduces randomness. So how do I show randomness? So let's say this is the time which I'm interested in. This t equal to 0. And let's say this is my time horizon, t equal to capital T. I'm standing here. Let's say this is my S today. And my job is to have an evolution of this stock price. So when I say evolution, I can have it this way, or maybe I can have it this way. I can also have it this way as well. Now, there is no way I can show the stock price this way, isn't it? Now, I can't show it in a straight line because if I show it in a straight line, that implies I have complete knowledge as to how exactly the stock is going to evolve over a period of time. But that is never the case, isn't it? Because whenever you look at any asset, there is always some bit of randomness which will be involved. Because if we know with certainty that where an asset will end up at a certain point in time, then we can make a lot of money. But market is unpredictable, and no one knows how an asset is going to behave over a period of time. So that is where the concept of random numbers gets used. So the wiggles which you see on these lines, this is nothing but the random component which is impacting my overall asset price path. And it is this now these are things whereby the concept of random numbers gets used in finance as well in order to introduce randomness into the behavior of assets because having certainty to an asset price path is very, very difficult. So we'll always want to have certain random portion being included, and that is where we'll start using random numbers as well. So how to generate random numbers and use random numbers, that is something which we'll see along the way. But this is a reason as to why random numbers are required in our analysis. So we'll be using them subsequently.
So what does W stand for?
So DW is also what we call as a Wiener process, or it's a geometric Brownian motion, I would say. And DW is, so you can split this up into, so I'll just split it up for now. So I have a phi root dt. So this implies that phi is the random number which is coming in from a certain distribution. So I could define, let's say, a standard normal distribution. And you can imagine I'm making independent number draws from the distribution. So we'll talk a bit about that evolution along the way. So before that, we'll quickly discuss scaling of mean and variance with time. And then we'll get on with the idea of how exactly I use this phi, which I call as a random number, which I draw from a distribution in order to model ds. So this is something which we'll discuss in tomorrow's class, that is on Saturday's class.
Okay, sir.
Okay. All right. So this is just a brief as to why we require random numbers. So any function in, again, now, those of you who have used Excel, and since you are aware of the concept of random numbers, have you used random numbers anywhere in your analysis? And how do you do it in Excel?
Sir, we used it once, I think last year. You can use the RAND function, RAND.
Very good. Yes, absolutely. Correct. So in Excel, you have a rand function which can allow you to generate random numbers, and anything in Python or maybe R, whichever. So Python, you guys will be familiar because that is one of the libraries which you have used earlier. So can you recollect where that might be used or which library might be used? Okay, so NumPy provides features in order to generate random numbers. So I think it is numpy.random dot whichever distribution you require. So and that is how Python can generate random numbers. R, I'm not very sure which library, but you guys know R, so you'll be able to figure out. So even I'm sure R will be having something to generate random numbers. So that way there are various approaches to doing things. So we'll discuss that along the way as well when we do some additional bits of hands-on. Okay, just erase screen so that you can do some discussion on scaling of mean and standard deviation with time.
Sir, what was the name of that asset pricing model?
So it is a geometric Brownian motion. So that is also what we call as a stock price diffusion equation.
Okay, sir.
So we'll talk about that anyways, because that is a base model for Black-Scholes Merton as well. So we'll talk about it in the next week also. Okay. Now quickly talking about how do you scale, how does mean scale with time? The scaling of mean with time. Okay. So a couple of concepts which we'll discuss today. We'll talk of scaling of mean with respect to time and scaling of standard deviation with respect to time as well. So two interesting concepts, something which will require going ahead also. So again, we'll talk about this or we'll try to relate this from a returns perspective. So let's say I write my returns as, let's say I write it as SI plus 1 minus SI upon SI. And let's say I want to write this to be equal to mu plus sigma into phi. So currently don't worry about what I've written on the right hand side. Don't worry about it too much. We'll talk about this. But returns, I would like to represent something as SI plus 1 minus SI upon SI, where SI is the asset price at the previous step and SI plus 1 is maybe the step after that. So that way you can imagine this is like a day over day return I may be looking at, or maybe any two time instances. And imagine there are no intermediate cash flows. So in order to keep things simple, we avoid any kind of intermediate dividends, etc., which would impact the analysis. Now, let's ignore randomness for now. Just for now, I'll ignore randomness. That is, I will drop the second term. So this phi is the term which introduces randomness into my equation. So for now, let's ignore randomness to understand the concept in a simple way. So if I ignore randomness, I would be able to represent this as, so ignoring randomness, for now, I can have something like SI plus 1 minus SI. All of these are subscripts, by the way, I plus 1, I, etc. upon SI. This is equal to mu into delta t. So let's say delta t is my very, very small time step. So we'll have delta t to be tending to 0. That way I have a very, very small time step. So this is another peculiarity which you will commonly observe in most math finance models. That is, we take a very, very small time step. That is, we take it in the limit delta t tending to 0. So that implies that we are taking a time step which is very close to 0, but it isn't 0 because it can't be 0, right? Because if I keep it as 0, then I'm not moving in time at all, which is not what I want. So I keep a very, very small time step. It will be very, very close to 0. Now, if I just rearrange this equation, so can I write this as Si plus 1 equal to Si into, it will be, if I move Si to the right hand side, 1 plus mu delta t. So I've simply taken Si common and I have moved this left hand side's Si to the right. So I have this. Now, if I want to apply, let's try this at different values of I. So let's keep on changing the values of I from 0, 1, 2, etc. So can I say that this equation, let's say at I equal to 0, I have S1 equal to S0 into 1 plus mu delta t. Similarly, let's say at I equal to 1, I have Si plus 1. So S2 equal to S1 into 1 plus mu delta t. Or can I also say this is equivalent to S0 into 1 plus mu delta t square, and so on. So that way, in general, at I equal to m, let's say I have m number of steps. So imagine that these are my time steps. So 0 was the first step, then I have 1, and similarly, I'm generalizing this to m steps. So there'll be multiple things in between, and I equal to m. So can I write this as Sm equal to S0 into 1 plus mu delta t raised to m? So everyone with me up to this point? Any questions?
So can you repeat what was delta t?
Yeah, delta t was a very, very small time step which I'm looking at, because what I'm trying to understand is how my mean is going to vary with passage of time. So to understand this passage of time, I'm taking this very, very small time increments. So delta t, you can imagine, is the time increment or a small time increment. That is, small word is very important, because we generally use a few simplifying assumptions as well, based on this small time step. So we'll talk a bit about that along the way. But that's a decent enough approximation which we use, which makes the modeling exercise easy. So having a very small time step is important.
Is this somewhere related to ticks of the stock price?
Uh, Not exactly, because tick defines the quantum by which a stock price can move. So that basically decides that this is the smallest change in stock price which can happen in order for that asset price to be moving on the exchange. So not exactly a tick size, but you can imagine this from a time perspective, because from a tick size perspective, we don't really talk about time, isn't it? Because that stock price can move by that much tick at any point in time. But here we are not really worrying about where the underlying stock price or the underlying asset price is going, but we are trying to relate this to a very small time step and understanding how exactly that underlying is moving accordingly. So maybe related to the idea of tick size, but not exactly the tick size.
Okay, sir.
So I've just generalized this for m steps, because I'll imagine that I have, let's say I have total m steps along the way. That is, I have my time t, which I have split into multiple parts. So let's say this is 0 to t. Imagine this is a very, very small, again, I've shown this larger, but imagine this time step is very, very small, and I'm further dividing this into individual delta t's. So all of these small increments are delta t's. And let's say there are m such steps. So that's why I have this SM thing, which I've used in the analysis. Now, I can also simplify this SM equation as SM equal to S0 into exponent into log of 1 plus mu delta t raised to m. Because exponent and logs, these are just derivatives and antiderivatives of each other. So they will cancel out. So So I can write it this way without really impacting the equation. I can also do this as S0 into exponent of m log of 1 plus mu delta t. I'm just bringing m below. Now, now I can do a small approximation here. So the approximation which I do is, again, for a very, very small time step, I approximate that log of 1 plus mu delta t is approximately equal to mu delta t. So for a very small time step, this is an acceptable approximation. So this results in step 6, which is Sm is equal to S0 into e raised to mu m delta t. Now I know that m into delta t is nothing but my entire time step, isn't it? Because if I focus on this small diagram on the top, I have this t as the time step, and I have split this up into smaller sub steps, which I represent by delta t. And I have m number of such steps. So can I say that m into delta t is equal to t? So can I write something like m into delta t is equal to my time step t, which I'm looking at? So if I replace it accordingly, this becomes Sm equal to S0 into e raised to mu t. So yes, we have an exponential relationship. Now, again, we refer to our very, very small time step. Now, because our small t is very, very small, this exponent, although this is an exponential relationship, we can call this as a linear relationship over a very, very small time step. So maybe one example of this could be, let's say, if there is a 1% daily return, which we are looking on a certain asset, then the return over 1 week can be approximately equal to 5%, assuming there are 5 days in a week. So so again, I'm taking a larger interval here. But for smaller time intervals, we can imagine that this exponential relationship can be treated as a linear relationship in nature. So one result which you guys will need to remember, now of course, that is something which you'll be using along the way as well. So that is something which I write here. So mean scales with time. So we have mean scales with time step or with time. So this is how generally mean behaves. Now this is part 1. Part 2 will be understanding how exactly standard deviation scales with time as well. Now, why mean and standard deviation are important? Because finally, these are the two items which are important for any distribution as well, or any probability distribution. And whenever we are talking from an asset price modeling perspective, we always refer to a certain underlying distribution for a stock. So it could be, let's say, a log normal distribution for an asset, because we don't want negative stock prices, isn't it? So again, that can be a place whereby I may want to understand how exactly mean and standard deviation move, because the ideas of these two things will help me model the stock price in a certain way. So that's why this is the first part which we study. So this is the result which you need to remember. Mean always scales with time. So although it's exponent, for a very, very small time step, you can imagine this exponent relationship is close to a linear relationship. And the second analysis which we are going to do before we take a break is how exactly standard deviation scales with time. So maybe once you guys note this down, let me know. Also, if you have any further questions, please bring that up. And then we can move on to the standard deviation part. So few of these things will be new to you. So and a few things may look weird at the moment, but don't worry. Over a period of time, gradually you'll get used to them. Because this is like a standard notation which you will find used in almost every textbook which you use, every textbook or reference book. So that way, I mean, don't worry about the notation, etc. Try to think of the concept, because that is more important. Uh, so have you guys noted this down? Can I erase the board and can I go to part 2?
Yes, sir.
Okay, okay. Now, part 2 will be scaling of standard deviation with time. We'll use the same setup which we had used earlier. So we have that n number of steps and increments are delta t, etc. Now, to understand this scaling, let's say that the standard deviation, so let standard deviation, which I also call as sigma, scale with delta t raised to delta, let's say delta t raised to alpha. Let's not worry about what alpha is at the moment, but I want to say that I assume that standard deviation is going to scale with this. That is, I can also say variance scales with it will be just the square of this. So this will be delta t raised to 2 alpha. Now, what should be the value of alpha? That is something which we want to figure out. So once we answer this, then we have our response to scaling of standard deviation with time. So let's try to understand that as well. Now, can I say that from time 0 to small t, there are t by delta t number of steps, i.e. t by delta t number of returns. Can I say that? That is, let me show this graphically. So let's draw this slightly a longer line. Let's say this is 0, this is t, and I have individual splits here. So I'll draw these delta t's to be slightly bigger. Actually, this whole setup is very, very small, but optically it will be difficult to visualize. So we have kept it to be larger. Now I have this as delta t's, and these delta t's are m in number. So can I say that if I have this total time step from 0 to t and I split this up into m steps of delta t each, can I say that there are t upon delta t number of steps? Accordingly, there are t upon delta t number of returns. Because for every time step, I can calculate a small return, isn't it? I'm moving from one time step to the next. Then from this to the next, and so on. So that way, over those intermediate time steps as well, I have some form of return which I can calculate, isn't it? Because I am making very, very small time increments. So accordingly, my asset is also evolving. And if my asset is evolving, can I relate this with the analysis of SI plus 1 minus SI upon SI? That is, I have this small increments which will lead me to SI plus 1s, and I already have SI for reference. So these over these small time steps delta t, I can calculate individual returns using this exact same formula. So does this sound okay? Okay.
Sir,
So that
how is it different from the mean one, the one just we calculated?
so the analysis is similar. Only thing is here we are trying to relate it from a standard deviation perspective. So we'll come to that in a bit. But the analysis is similar because our setup essentially is the same.
Okay, sir.
Yeah. Okay. So just a couple of more steps. So now we have, therefore, we have t by delta t number of variables. So I can also call that return as a type of a variable. Variables, i.e. returns. Because these returns are also something which I can treat as a variable, isn't it? I don't know what the return is going to be. So that depends on the evolution of the stock price. So I can call that as a variable. So these number of variables, and these are each with variance of size delta t raised to 2 alpha. Now, if I add up these variances from 0 to t, now I can add up these variances because I am assuming this process to be IID, so which we call as independent and identically distributed random numbers. So don't worry about IID right now. We'll talk about IID in the next step. But for now, I just want to add up these individual variances for each of these t by delta t number of returns which I have. So if I can add up variances, it would look something like this. So the total variance, if I add up all of these individual variances, would be the total variance from 0 to t. So let me write this explicitly as well. From 0 to t. This will be t by delta t into delta t raised to 2 alpha. I'm simply adding them up. Now, I want to find out a value of alpha such that I have a process which is finite, and also it should not be zero. That is, I want to have a stable time step or a stable evolution for the variance. Because if I choose some random value of alpha, that is going to create problems for me. So I want to have a certain unique value of alpha, which will help me stay finite, as well as I'll have a non-zero variance. So that is what I want to do. And a value which comes to my mind is I would want to choose alpha equal to 1/2. So if I choose alpha equal to 1/2, the above equation becomes t by delta t into delta t raised to 2 into 1/2. So that way I can cancel out my delta t's. So I have variance which is going to scale with t. So standard deviation will scale with square root of t. So another result which you need to remember, and something which we'll require later on. So we are going to be using this during our discussion on risk management as well. So when we talk of risk models, we are going to use this, we are going to borrow this result once again, which is standard deviation scales with square root of time. So we'll see a practical application of this as well. So this is a result which you'll need to remember. Now again, later on also we are going to use these same small time steps delta t. So whenever we study the Wiener process, and there are other concepts which we call as Ito's lemma, etc., which we discuss maybe after the break. That is again a place whereby this delta t is going to crop up, and again we work in the limit delta t tending to 0, and the results which we have taken here, scaling of mean and standard deviation with time, that is something which we will require not just for now but even for subsequent sessions as well. So this is another result which is practically very useful. So we'll talk about that practical use along the way once we introduce ourselves to the concept of value at risk. So at that time, we try and relate this scaling of standard deviation with time and how exactly you can use it for maybe your regulatory or management reporting as well. But this is one result you will need to remember, that is standard deviation scales with square root of time. So two things basically, mean scales with time and standard deviation scales with square root of time. So once you remember these two, we are good to start. I mean, this is like the basic things which we require. So familiarity with this will help us help us take the next step. Okay. Yeah, we are at almost 10:15, is it? Yeah, 10:15. So we'll take a quick break for 5 minutes and we'll come back. So when we come back, we'll start with our discussion on a Wiener process. So we at least try to understand what is a Wiener process and then maybe relate it with the concept of ETOs, so which we call as a ETOs process as well. Today, let's see if we get time, we'll talk a bit about ETOs lemma. Otherwise, we'll keep that to the next time. But Wiener is something which we'll definitely discuss after the break. So it's 10:15, 10:17 by my clock. So probably around 10:20 or maybe 10:25, let's regroup and we'll take our discussion ahead. So a
So,
quick,
so
yes,
can you
please.
tell any reference book?
Yes, yes. So a couple of good references for this. So maybe let me ping it in the chat so that everyone can have it. So one is John Hull. So JC Hull, definitely. Paul Wilmot. And of course, there are other advanced books as well, but I wouldn't really recommend them at the moment. And maybe any other relevant stuff which you find on online as well, because these are like basic concepts which you will get to see in almost any book. But Hull and Wilmot are pretty decent references, I would say. And I think Hull is more of a textbook now, although we call it as a reference book in the industry. Also, people use it more as a textbook. So possibly Hull and Wilmot could be a good point to start. All right.
Okay,
So let's take a break and we'll regroup in like 5 minutes. So we'll regroup by 10:25 and we'll take our discussion forward. Hi guys, can we resume? Is everyone back?
Yes, sir, we're back.
Yes, sir.
Okay. Now let's try to understand an important concept which we call as a Wiener process. So Wiener process is something which will help us understand asset price evolution as well. So a Wiener process is what we call as a type of a Markov process. So to understand what is a Markov process, now a Markov process or any variable which follows a Markov process is the one whereby all of the available information about the variable is incorporated in its current price level, you would say. Or maybe another way to put that is something which has happened in the past doesn't have any impact on what the value of the variable is at the moment. That is, we basically look at how exactly the variable is going to evolve in the future or going ahead. So one of the examples can be stock prices. So you guys must have studied the idea of efficient market hypothesis. So the EMH hypothesis states that whatever information is available about the stock in the public domain is incorporated in the current stock price level. So that way, all that we are worried about is where the stock price would go from here. That is something which has happened in the past. For that stock is already incorporated into the price. We don't have to keep track of the things which have happened in history. So that is an example of a Markov process. So for a Markov process, you can also imagine that this is the process which doesn't have any memory, or it is a memory-less process. So a current stock price for a certain stock which is transacting, let's say on an exchange, we can say is following a Markovian process, because whatever price history the asset has followed, it is something which we are not really concerned about, because all of the information has been included as a part of that particular stock price. So always remember that a Markov process is a process which doesn't have any memory. That is, it is a memory-less process. Now, a Wiener process is also a type of a Markov process. So again, just extending the idea of Markovian processes, a Wiener process also does not have any memory. That is something which has happened in the past, doesn't have an impact on what is going to happen in the future. So that way, that dependency does not exist. So that's why even a Wiener process will not have any memory. A Wiener process is also a memory-less process. It doesn't really remember what has happened in the past. So the same assumptions which we are going to follow for the Wiener process. Now, let's say there is a certain variable z which follows a Wiener process. So say variable z follows a Wiener process. Guys, is my handwriting legible? Is it okay for everyone to read? Do you want me to increase the font size, reduce it? I'm not saying my handwriting is very artistic, but is it legible?
Yeah, sir, we can read it.
Yes.
Okay, great. All right. So let's say there is a certain variable z which follows a Wiener process. Take any variable z. So there are a couple of properties of this Wiener process which we will require going ahead as well. So firstly, the increments or the change in z, that is the, let's say I say values of delta z. So you can say delta z is the change in z. So the values of delta z for any two short intervals of time are IID. So IID stands for independent and identically distributed. So that implies that Z or the increments which are coming in Z, they are not dependent on each other. That is, let's say I have two increments. Let's say I have a ZI and I have a ZI plus 1, which I'm looking from an evolution perspective. then these two are not correlated. That is, what the value of zi was has no impact on what the value of zi plus 1 is going to be. So that way there is an independence. But at the same time, we are using a common probability distribution to study this. That is, the distribution assumption remains the same. So although they are independent, they have a common source distribution. So that's why we say that they are independent and identically distributed. Why? Now, first I, which is independence, has to do with no dependency between Zi and Zi plus 1, and identically distributed because these two increments, Zi, Zi plus 1, come from a same probability distribution. And we'll assume a standardized normal distribution where n will follow something like a 0 and a 1, where we have a mean of 0 and a variance rate of 1 per year. So this is our distribution which we are going to use going ahead. But this is the idea of IID. So let me write the second property as well, and then we can take any questions, if any. Also, we say that delta Z can be represented as epsilon root delta T. So epsilon, I think I just represented epsilon by a phi earlier. So we can say epsilon is a random number where epsilon is a random number drawn from a standardized normal distribution. Random number drawn from a distribution. So we are going to use these relations when we build our asset price path as well. So probably in the next week when we talk of maybe week, either next week or week after that, when we complete our Black-Scholes and numerical techniques, we are going to do our hands-on bit on Monte Carlo simulation and finite differencing scheme. So at that time, we are going to use this epsilon, which we call as the random number for helping in evolution of the stock price. So that is something which we'll talk about in the next week. But these are a couple of properties which are unique for any variable which follows a Wiener process. So firstly, increments in delta Z are IIDs. Also, delta Z is represented by epsilon root delta T, where epsilon is a random number which comes from a certain distribution. So these two are the properties which we'll require in our analysis as well. Again, these are just the standard things which are specific to this Wiener process. Now, if I would want to generalize this process a bit, so if I had to write a generic Wiener process, so this is just the basic definition and properties of a Wiener process. Now, by the way, Wiener process is a popular technique which we use for evolution of stock prices, FX, commodities, etc. For interest rates, it's slightly different. Some ideas which we study here can be used when we study interest rate evolution, but interest rate models are comparatively complex as compared to equities or FX. So at the moment, we'll stick to equities and FX before we get comfortable. And once we do that, then probably we can move on to interest rates. So rates is something which will come at a later point in time. Now, if I have to generalize the Wiener process, so if I write a generalized Wiener process, I could write it as something like this. So a generalized Wiener process could be written. So let's say I have a certain variable x for which I want to write a Wiener process. So I could write this as dx equal to a into dt plus b into dz. So this is like a standard form which we had seen some time back as well. So if you recollect, I had earlier written as something like ds equal to rs dt plus sigma s dw. So this R and S is something which I'm generalizing through this variable A, and sigma into S is something which I am generalizing through variable B. This dt is the same as the dt here, and many books use dw or dz interchangeably. So both of them mean the same thing. Both of them mean a geometric Brownian motion. So that again relates to the same Wiener process. So GBM is nothing but another name which we use for a Wiener process. So just a synonymous term. But when you talk of a geometric Brownian motion, people will know that you're talking of a Wiener process and vice versa. So A is technically, A is what you call as a drift rate. So just a technical term which we give to that. And B is what we call as a diffusion. So these are just technical names which we give to them. Now this is like a continuous time notation, the one which we have written here. So we can also write this in a discrete form. So how do I do that? Only a slight change in notation would happen here. So this is continuous. Now if I have to write this in a discrete form, I can write that easily. So in a discrete form, I could write this as, so dx would become delta x, so a small change in x, equal to a into delta t. So for now, don't worry about what is a and b, because a and b will keep on changing depending on what model we are looking at. Now for a stock price random walk or a stock price diffusion, we know the standard equation which we have written at the top. But otherwise, if we talk of interest rates and if we try to define A and B, then that A and B will be different every time, because we have a variety of interest rate models which are available. And for each of them, we have a different value of drift and diffusion which is defined. So let's not worry about the form of A and B at the moment. And this will be plus B into discretized form, which is epsilon root delta t. And this epsilon is nothing but the random number which I am drawing in from a certain distribution, which I assume as the standard normal distribution. So again, by looking at this discrete form, it gives us an idea as to how random numbers are going to impact our evolution. Now, random numbers are something which are coming in the second part here, this epsilon bit. So epsilon is introducing randomness. First part is deterministic, there's no problem. But second part, this is where the uncertainty about a certain asset comes into play, and that is where that epsilon thing gets used. So how exactly those random numbers get used and how do you devise an asset price path is something which we study when we talk of Monte Carlo simulation. So what we have done initially is we have understood what is a Wiener process. We understood that it was a type of a Markov process. Then we studied a couple of properties of Wiener process, which you are given as the first two which you have written at the top. Next, we try to generalize the Wiener process, because finally where I'm trying to get to is I'm trying to relate the Wiener process with something which you will want to apply, let's say for a stock, because I may have a certain derivative which could have stock as the underlying. And if I want to understand the behavior of that particular derivative, I need to relate that with these concepts. So as a next step, now up till now, if you see, I haven't really introduced any kind of time dependency. So I'll tell you the meaning of time dependency. So currently we have just written A and B. It's a very, very generic form. I haven't written anything about A and B yet. Now, if I want to make this thing dependent on time and the asset, that is, if I want to have A and B, which are dependent or a function of underlying and time step, then I can write that as well. So if I want to have something like A of xt, whereby x is my, let's say x is the underlying and t is the time step, then I can introduce this dependency as well. So if I do that, I can write dx equal to axt dt plus bxt dz. So all that I've done is I have taken the generalized Wiener process and I have just introduced dependency on the underlying asset x and the time step t. And this form is what we call is an Ito's process. So just one step ahead, but Ito's process. And the idea why I have introduced these two things, x and t, is because finally I want to apply this to a certain derivative, which is dependent on a certain underlying asset. So imagine that x is something like a stock price. So I may want to write this something as a of s comma t, whereby I can say that, or maybe rather than this, maybe I would want to write this as probably v of st, something like this. So this is something which I may want to study. Now, let's say V is my option price. Now I know option is a derivative product. So option will be dependent on the underlying stock price and the time. So finally, I want to use these concepts which I have been building for now, Wiener process and ethos. I want to apply it for understanding for a behavior of a derivative. And for that reason, I have introduced this asset and time dependency for variables A and B. So any questions up till this point?
So I have a question here. I lost connection in the
Yes.
middle, so you might have covered it. But how is this different from a random walk process?
So this is the random walk process. So yes, so
It
it's
is
a
it, right?
synonymous. Yes, absolutely. So
Okay.
technically only difference is in a discrete system we call it as a random walk,
Mm-hmm. Okay.
whereas in continuous time we call it as a diffusion system or a diffusion equation. So technically they mean the same thing. Only thing is it's the difference between continuous and discrete time. But otherwise, logically they are absolutely equivalent.
Okay, and sir, again, like, could you just repeat once what this drift
Yes.
term is?
Yeah. So again, these are technical names which we give. So currently, I would say that don't worry about the drift and diffusion part at the moment because these will keep on taking different formats. So that is just so if I just relate this with my above equation, which I've written right here, then you can imagine R into S is nothing but, or R, I would say that take S common. So if I take S common, I would have something like R dt plus sigma into dw or dz. So I have R, which I call as the drift rate, and sigma is what I call as the diffusion rate. So somehow I'm trying to relate this with the underlying distribution as well. So you can imagine I'm trying to relate this with the mean and standard deviation, which is being followed by my probability distribution, which is underlying this process. So for that, I'm technically giving names drift and diffusion.
Okay, sir, sure.
Any more questions for anyone? I just erase the above parts to avoid any confusions. Okay. So actually, these are good building blocks because this helps us relate with various things which we actually use for our practical modeling as well. So that is somewhere we'll require these ideas. So we still have, we have some time. So can we do one simple derivation to understand this behavior for a derivative? So there are three steps which I would want to demonstrate. So we'll do it step by step. So we will take a certain process or a certain variable G. You can imagine G is a certain product. And it's initially a function of X. So if I just write it on the whiteboard. So we'll do a step-by-step thing because I want to demonstrate what we call as an Ito's lemma. So Ito's lemma is a result whereby we can, which we can apply to understand the behavior for a movement in the price of a certain derivative. So for that, so is everyone familiar with the concept of Taylor series, something which you might have studied earlier? So I don't expect too much of a background on Taylor series, but at least do you have a brief idea of what is a Taylor series? Okay.
Sir, could you just explain that, please?
Yeah. So a Taylor series is an idea whereby we try to understand how a certain variables or a certain product's value is getting impacted because of something, or maybe how the value of a certain product is evolving over a period of time. So that is what we can study through application of a Taylor series. So what we do is we'll write the Taylor series, and we won't need the entire Taylor series. Just a small introduction to Taylor or maybe usage of that basic should be good enough. So maybe I'll write the Taylor series and then we'll talk about it. Now again, as a part of this lemma process, I want to take this in three small steps. I don't want to directly jump to the third step because it will be difficult to relate. So initially, now I'll again keep this setup as general. So I have a certain product G, which I initially say is a function of X. Then I would like to take g as a function of, let's say, some variables x and y. And finally, I want to have g as a function of x and t. So why I say that we take these three small steps, I can directly jump here as well. But then relating this thing with the actual analysis will be slightly difficult. So we'll start easy. So g equal to f of x is an easy thing because there's just one variable where we have this dependency. G equal to f of xy is just one step ahead. So that is we had initially one independent variable. Now we have two independent ones. And finally, we extend this concept to the ETOS process. Now, why I say ETOS process? Because if you see, there is a time component which has come in here. Now, time has nowhere been considered in the first two steps. So first two steps have nothing to do with ETOS. But ETOS can be applied to step number 3 because I have this form. I have this underline and I have this time step. So I would like to take it step by step so that it brings clarity as to what exactly we are doing. And at that time, we'll apply simple concepts of Taylor series, nothing very complex. So that way, understanding that will not be very difficult as well. So can we begin? Are we good? Okay.
Yes, sir.
Okay. So I'll just erase this so that I have the full whiteboard for my consumption. Again, we have a function g, which is a function of x, or maybe a certain way. Just switch colors. I have a certain variable g, which is a function of x, and I'll assume g to be a differentiable function of x. So I can say that by normal rules of differentiation, I can say delta g is approximately equal to, I won't say exactly equal to, this is approximately equal to, I don't need a partial right now. I can just have a full derivative. It's dg by dx into delta x. Now, this is just a standard definition of the first derivative of the function, isn't it? So I'm just representing it that way. Now, if I want to apply Taylor series to understand the evolution of the above, so I'll show you a simple form of Taylor series here. So Taylor series expansion for step 1. We have delta g is equal to dg by dx into delta x. This is my first term. Plus, I have the higher order terms as well. That is 1 by 2 d2g by dx square into delta x square plus all the higher order terms here. So that way you can imagine Taylor series is an infinite series whereby we look at higher dimensions. So for now, just the first two dimensions are good enough for us because for our current analysis, we don't need to go beyond this second order. That is second order in the underline. You can imagine x as the underline. So for most of our applications, which we are going to study in this subject, we are going to stay in the first order of time and in the second order of the underline. So I will be staying in first order of time and I'll be staying in the second order of the underline. So when we actually apply it, you will understand what do I mean by these two things. So don't worry about this too much at the moment. Now, you can also relate this with something which we study in bond price evolution. So even when we study bond pricing, we are actually applying Taylor series in the background. So can you relate that the first term is very, very similar to duration and the second term is very, very similar to convexity? and then all the higher order risk parameters. So can you visualize this? So does this look similar to what we have discussed some time back? Just these are generic variables. But if you just replace g by p and x by y, so we have a dp by dy into delta y plus 1 by 2 d2p by dy square, etc. So can I say that this is something similar to duration and the second term is something similar to convexity? Would that be a right way of putting it? So why I say this, because I am looking at the form of this first term. This is the first order differential and this small increment in the underlying. Again, this is the second order differential and this is the just a square of the underlying. That is, this understands linearity because it's a first order change, whereas this understands curvature. So I'm just trying to relate or give synergies between this and the bond pricing, which we are already familiar with. Now, we don't require bond pricing at the moment, but these similar concepts are applied there as well because we directly use duration and convexity. But this is the underlying theory behind how we use duration and convexity. And this is how duration and convexity have an impact on the overall bond price. So that way, a Taylor series can also be applied for analyzing the behavior for a certain underlying like a bond as well. So that way, Taylor series has applications there as well. We directly use results, duration, and convexity, but this is the underlying theory behind it. I'll just erase this. This is not required right now. Duration and convexity is what we'll study later on again. Okay. Now, I've written the Taylor series expansion, and I would like to have this, or maybe I want to have a very, very small change in delta x. That is, now let's say I'll leave it this way because finally I don't really want to use this. I want to extend this to x and y. And imagine that we are working in a very, very small time increment or a small asset increment here. We have delta x tending to 0. And I'll be introducing y in a moment. So for now, we'll take delta y tending to 0 as well. So we are working in a very, very small limit. So now, if I want to extend this further, now if I want to make g as a function of x and y. So if you recollect, this is step number 2, which I had written earlier. Initially, I take g as a function of x. Why I write this? Because this is easy to understand. Now, this is something which you don't require in Ito's lemma, but it is a gradual step up. We don't want to directly jump to the Ito's process. This is step number 2. We haven't reached Ito's process yet, but the ideas which we build here will help us relate with the Ito's process. So now G is a function of X and Y. So can I also say approximately that this thing can be written as delta G is equal to, now do I write a dg by dx or do I write a dabba g by dabba x? So can I write it as dg by dx or do I need to write this as dabba g by dabba x? What do you think? I want to write something which is similar to this one. So should I stick to this? The second one.
So
Very
maybe
good. Correct.
it will be the second one.
Very good. Yes, the second one, because I have two variables, right, on the right hand side. So now G is a function of two items here. So I cannot write an ordinary differential anymore. I'll have to switch to partials. So I can say that this is approximately equal to, using the same ideas as earlier. Only thing is I'll switch to partials. So we have dabba g by dabba x into delta x plus dabba g by dabba y into delta y. Again, if I want to apply Taylor series to the step above, so if I apply Taylor series, because I have a slightly extended Taylor series now, I have an x and y term. So my Taylor series would look something like delta g is equal to dabba g by dabba x into delta x plus dabba g by dabba y into delta y plus 1 by 2 dabba 2g by dabba x square into delta x square, and so on. And I have y square, etc. Now, to solve this, to simplify this Taylor series, I'm going to work in a very, very small limit, which I write here. So I'll be working in the limit delta x as well as delta y are tending to 0. So I want to have very, very small increments. So in most of our analysis, we are going to work on these small increments because there are certain advantages to doing this as well. So we'll talk about that along the way. But we are working in a very, very small time limit or even a small asset price increment limit here. So if I apply these limits here, can I roughly say that that let's say if I want to write this in maybe a continuous time form, let's say, can I write this as dg is equal to, I'll just write it in another color because there's not enough space here, so that it will help us differentiate. So in the limits that these things are tending to 0, if I write this in a continuous time form, it would look something like this. Sorry, I just need to switch colors. So blue. So can I also write this as dg is equal to dabba g by dabba x into dx, and we have a dabba g by dabba y into dy. So I've just applied these small limits, that is delta x and delta y are tending to 0. So this is something which we'll just park aside. Now, for the moment, I'm going to name this as equation A, something which we'll use later on. So I'll just keep this equation A. So even if I erase the top 3 steps, I'll keep this equation A. So for now, don't worry about this. This is something which we'll consume later on. But equation A is something which we are going to require in our next step, because up till now, if you see, we haven't really spoken about time. Now, as a next step, I may want to introduce a time step. That is, I may want to have G as a function of X and T. So this is the step number 3. So now actually we are applying ETOs. Up till now, we haven't done that because we never had that asset and time dependency. So applying ETOs process was not possible. But now I can define this in the form of a ETOs process. And that is what I would do next. So can I erase steps 1 through to steps 3?
Yes, sir.
Okay. So we'll leave step 4 as it is because I want that for reference purposes. Okay, so it's just equation A. We'll keep it this way. Maybe I'll just use a separate color to avoid any confusion. Now I have a step 5. Now for the first time, I'm going to introduce a time dependency here. That is, so I'll do 2 things actually. So firstly, I'm going to make G as a function of X and T. So I can say G of XT. And I'm going to define a process for my underlying variable X as well, because finally, if you recollect what I mentioned earlier was I want to relate this from the perspective of a derivative. That is, finally, I want to use all of these things when we talk of option pricing in our subsequent sessions. So I want a certain process to be defined for my underlying as well. So you can imagine X is like my underlying variable, which is impacting my option price. Let's say G is my option price and X is the underlying asset and T is the time. So along with G as a function of XT, I also want to say that dx is equal to AXT dt plus BXT dz. So these are the 2 things which I'm doing now because I want to apply the concept of ETOs here. That is this, I want to define this in terms of a ETOs process so that I can proceed further. So does step 5 look okay? So in step 5, I've done 2 things in one shot. I have firstly made G dependent on the underlying X and T. And for the underlying as well, I have defined a separate process, which I call as the ETOS process. So two things have been done in step 5. So does that look okay? Any questions? Okay. Okay, so currently it's just a generic setup. We can just replace this x by s or whatever variable we want later on. I have deliberately kept it as generic for now. Now, if I do a simple Taylor series expansion for this, now the behavior for Taylor series will be slightly different here. So we'll talk about that as well. So guys, just bear with me for maybe 2-3 more steps and we'll have the result. So we have a delta G is equal to dabba G by dabba X e into delta X. Because the thing is, the result which we derive now can be applied to a variety of products. So it can be, let's say, a forward contract which you want to analyze. So even, or maybe any other derivative which you're trying to assess, these kind of results can be studied there as well to understand how the behavior for that derivative happens. So we are gradually reaching there. So just 3 to 4 more steps and we are done. And we have a dabba G by dabba T into delta T plus 1 by 2 d2g by dx square into delta x square plus 1 by 2 d2g by dt square into delta t square and so on. Now, in this case, we are working in a very small time step. Now, let's say I call this as equation B. So now we want to compare A and B. So there's a subtle difference between A and B. So the thing is, in equation A, we have no mention of time. Also, at the same time, we don't have a process which has been defined for X. But that isn't the case when we talk of equation B, because for equation B, we have two things which we have done. Firstly, we have introduced time dependency. And secondly, we have defined a nature for X. Because now X has a separate identity of itself, which we define through the dx process. So that is something which we want to apply here. Now, when I say a very small time step, that means I am working in the limit delta t tends to 0. Now, whenever I'm working in the limit delta t tends to 0, what simplifying assumptions I make is I only hold those time steps which are having an order of 1. That is, I will use delta t. This is valid. But anything of the higher order, so something like delta t square or maybe delta t cube, this is something which I don't have to worry about because these are so small that I can ignore their impacts. So I'll be handling only those time steps which are first order in time. Anything of the higher order in time steps, I'm simply going to equate them as 0. So just a simplifying assumption which we use for our modeling purposes. So that way, if you see equation B, this third term, the fourth term, I can simply ignore because I have a delta t square, isn't it? Now, why I do this? Because imagine I choose delta t to be equal to 0.001. Now, if I do a delta t square, this will be squaring of this. So it will be 0.00001. So this is an even small time increment. So that way it doesn't have too much of an impact on the final result and the analysis. So to keep the modeling activity simple, we are going to ignore everything which is higher order in time. We are only going to stick to first order in time. So this last term is going to vanish. So does this look okay? We haven't spoken about delta x square. We'll talk about that in a bit. But is everyone convinced with the treatment which I'm applying for delta t and higher orders of delta t? Okay. So a very small time step. So delta t is very small. Now let's see how this delta x square is going to behave. So for the moment, let me just refer to this in a discrete format. So I'll use this equation for dx, which I have written. Sorry, I just switch colors. And I'll just discretize this because I want to extend delta x square. So what I'll do next is I'll just work on this delta x square bit, how exactly that is behaving, so that I can just plug that into the analysis and then we can have a result. So let me solve delta x square. So firstly, let me write dx in this form. So using dx, now firstly I am just working for delta x square. So to do that, I will define my equation for dx as delta x. So I'll just, okay, so let me keep the x and t for now. I'll just drop it later so that I don't have to write too much into delta t plus b into xt into epsilon root dt. Because I have dz as a Wiener process, isn't it? So I'm using the same concept of the Wiener process, which we have studied earlier. So I know that delta z was epsilon root delta t. So that is the exact same thing which I've done here. I've done an epsilon root delta t here. Everyone with me up to this point?
Yes.
Yeah. So just a couple of more steps and the agony will be over. I hope it's not too agonizing, but still. Yeah. Delta x square. I'll just drop x and t, guys. I mean, I'll just write it as a square. Imagine x and t are there, but just to keep the equation simple, I'll just drop it for now. So I have a square. So simple expansion, a plus b bracket square. So a square plus b square plus 2ab. Now again, I'm going to use the time step logic here as well. So any terms which are higher order in time, we ignore them. So the first term is going to vanish because I have delta t square. The third term will also vanish because I have delta t raised to 1 and delta t raised to 1 half. So I have delta t raised to 3 by 2, which is delta t raised to 1.5, which I don't want. Anything which is higher than delta t raised to 1, I'm going to ignore. So this takes me to b square epsilon square delta t. So let's try to simplify this a bit. Now we have epsilon is a random number which is drawn from a standard normal distribution, which has a mean of 0 and a variance rate of 1. So we are going to use that to simplify this thing. So we have something. So if I were to write this in a normal variance equation format, if I try to simplify this, so simplifying. So I have, since I know the value of variance, can I say expected value of epsilon square minus expected value of epsilon bracket square is equal to 1. So this is just the standard way in which we refer to variance in a normal circumstance as well. So this I know is equal to 1. Also, I know the expected value of the variable is 0 because I am following a process as 0, 1, which has a mean of 0 and a variance rate of 1. So mean is also what we call as the expected value of a certain variable or a certain item. So expected value of epsilon I know is 0 because that's my distribution. So I have expected value of epsilon square minus, now this is just a 0 term. So 0 is equal to 1. Therefore, I can say that epsilon square is equal to 1 or equivalent to 1. So using this simplifying assumption, I can drop this epsilon square from my analysis. So I'm just simplifying this whole thing. So this becomes b square into delta t. I don't have to worry about epsilon square anymore. So this is nothing but my delta x square. And finally, if I just simplify my equation, I have one important result, which I call as Ito's lemma. So I'll just erase the last step. That last step is not really required anymore. That was just a build up to the Ito's thing, which we discuss now. So I'll just erase this part A. Now, this gives us one result which we call as a Ito's lemma process. So we have a DG. Let me just use some other color. So step number 7, I have a DG is equal to daba. So I'm just using equation B and I'm rewriting it here. So I have a daba G by daba X into dx. I'm just writing it in continuous form, plus daba G by daba T into dt, plus 1 by 2 daba 2G by daba X square. And I know delta X square is B square delta T, or B square dt now, B square dt. And this result is what we call as a Ito's lemma result. So a variety of applications to Ito's lemma. You may want to study the behavior for a certain derivative, something as simple as a forward contract. And for that as well, you can apply Ito's lemma and use it for your analysis purposes. Now I can further maybe want to simplify this. So maybe one more step can be I can just open up dx. So I know dx is a dt plus b dz. So I can just substitute something for dx and solve that as well. But that's just a natural extension. So even if you don't write that, that is good enough. But this is a result which will help you in further understanding the behavior for a certain, let's say, a certain derivative product. So this is what we call as a Ito's lemma. So just a recap of what all things we have done today. We started with the Wiener's process. So we understood what is a Wiener process, why it's a Markov process. Then understanding the properties of Wieners, so the two properties which we discussed. Then we generalized the Wiener process a bit. As an extension, we introduced asset and time dependency. So that is where we defined the Ito's process for the very first time. So that was where, and that was the first part. Then as a next part, we had to derive the result of Ito's lemma. Now, why lemma is important? Because that helps us understand the behavior for various derivative products. Or maybe, now here we are specifically talking of options now. So options, you can apply this for forwards as well, but I would want to talk from an options perspective. So that way, it's a result which helps us understand the behavior better. Now, for getting to Ito's lemma, we followed a 3-step process. We did not jump to the Ito's process directly. So initially, we took a product G, which was a function of X, a certain variable X. Then we took G as a function of X and Y, just one step ahead. And in the end, we introduced the Ito's process. That is, we introduced asset and time dependency. Also, we defined a separate process for dx as well. So the dx is very, very similar to the geometric Brownian motion, which we just discussed some time back. So we defined that process, which we call as a type of an Ito's process. And then we did our analysis to get to Ito's lemma. So this is just a quick recap of what we have done for the last 1.5 hours. But this analysis is something which sets the tone for our further discussion on Black and Scholes model. So again, these things may appear to be slightly challenging at the moment, but that's the thing, right? I mean, everything can't be easy. Now, some things have to be challenging so that once you master them, that will give you further confidence to explore something more. So even if some things appear difficult right now, don't worry. Over a period of time, gradually you will master them. Maybe going through references like John Hull, Wilmot, or any other reference which you like online as well, that should be good enough. But from an exam perspective, I think whatever we discuss in the class, only those things are covered. But I would say from a broader understanding perspective, try to read as much as possible, because in the classroom, we can only cover that much. But beyond that, it will be up to you guys to pursue certain concepts in the future. So that is something which will help later on. Okay, so good. So I mean, we have covered good ground today. This was what I had planned for today's class. So we can stop here today. So before we leave, and we'll quickly take the attendance. Let me just open up the attendance sheet. Yeah, so session number 5. Okay, so we'll start with financial economics. Akash Singh. Achal Jain.
Present, sir.
Okay. Ayush is present. Yeah, Ayush is present. Yes. Adesha Hati. Tejas Akware.
Present, sir.
Okay. Ali is present. Anjali Garg. Anmol Sen.
Present, sir.
Arismita Deka.
Present, sir.
Avni Mishra. Ayushi Rotagi. Sarvesh Bagal.
Present, sir.
Bhavya Dang. Cherry Chabra.
Present, sir.
Diksha Chauhan is present. Dipansha Singh.
Present, sir. Present, sir.
Yes, yes. Gaurav Kadam.
Present, sir.
Gaurav Datir. Gaurav. Himanshi Verma.
Present, sir. Excuse me, sir. You have Diksha Chauhan present now.
Diksha Chauhan. Yes, yes. I marked you present already.
Okay. Thank you, sir.
Jaideep Saini.
Present, sir.
Okay. K. Ayushi.
Present, sir.
Riya Shukla.
Present, sir.
Okay. Kriti Marwa. Mansi Singhal.
Present, sir.
Mansimran Arora.
Present, sir.
Manvi Kukreja.
Yes, sir.
Mihir is present. Muskan Garg. Namrata Gaur.
Present, sir.
Okay. Neil is present. Neil Dhar is present. Nikhil Agarwal.
Present, sir.
Prasoon Sharma.
Present, sir.
Pratik Maheshwari. Rachit Tyagi. Rahul Ghosh.
Present, sir.
Rahul Giri. Rahul Goswami.
Present, sir.
Raj Aditya Singh.
Present, sir.
Rashi Jain is present. Rishabh Kothari.
Present, sir.
Ruma Keshri.
Yes, sir. Present.
Sahaj Manocha.
नीलो म्यूट कर दे शुभम का
Sahaj is absent. Samiksha Chopra. Sharanya Bhattacharji.
Present, sir.
Shubham Jain. So I think Shubham has pinged me. Is it right now? One Shubham Kumar has pinged. So Rachit, yeah, Rachit has just logged on. Okay, so Rachit was present. Okay, let me just mark Rachit as well. Okay, so Rachit is Shubham Jain is absent. Yeah.
Present, sir.
Okay, present. Sorry. Shubham Kumar.
Yes, sir. Present, sir.
Someshwar Verma. Stuti Mehrotra. Sanika Thakur.
Present, sir.
Vinaya Pawar.
Present, sir.
Okay. So FE class is done. So financial economics guys, you can leave if you have another commitment after this.
Excuse me, sir.
Yes.
Sir, can you mark for Akash Singh, financial eco? First.
Akash Singh. Yes. Okay.
Thank you, sir.
All right. Yeah. Okay. So you guys can leave in case you have a separate session after this. I'll just complete the roll call for international business class as well. Ayush Sharma.
Present, sir.
Alisha Gupta. Vidhi is present. Anant Jain. Anish Dhopeshwarkar. Anjali Sethi.
Present, sir.
Arshata Imam. Barkha Israni. Bhavya Patel. Saloni Bhujbal,
Present, sir.
Chaitra Tirodkar,
Present, sir.
Devam Pandey, Diksha Kalra, Gauraja Nevatia is present. Gayatri Narkhede, Govind Mittal, Savan Hake is present. Himanshi Virmani is present. Indu, Ishita Saxena, Anika Goyal, Karthik Mittal.
Sir, Ishita Saxena present.
Okay, okay. Karthik Mittal, Asro L, Lakshya Singhal,
Present, sir.
Mahi Rajawat, Mansi Gupta, Athagi Warrior,
Present, sir.
Megha Parak, Nancy Halawat, Neha Jain,
Present, sir.
Pratishtha Pradhan is present. Rohan Bagai, Rohit Potar, Samita Malik, Shivangi Semwan, Simran Pahuja,
Present, sir.
Srishti Verma, Anu Goyal, Tarang Kadyan, Kalyani Todkari, Twinkle Karnawat, Vaishnavi Shrotria,
Present, sir.
Vanishka Jain, Vibhor is present. Vidushi Rana, Yash Mehra.
Present, sir.
Okay, great. So thank you so much. Thanks for joining in. And I look forward to meeting you guys on Saturday. So Saturday morning, we'll have our class at 11:30. So look forward to meeting you there, and we'll take our discussion ahead on Black-Scholes model at that point in time.
Sir,
Yes.
Kalyani Todkari from IBF is present.
Oh, okay. All right. I'll mark. Okay, yeah, I'll mark that. Yes.
Thank you, sir.
Yeah. Thank you.